Alright, so real quick, I wanted to go ahead and first I want to talk about, you know, I'll share trades here and there when I think it can help others in serving a purpose. And I think this is kind of one of those moments. So ended up there was one trade where I just had really bad trade management, and that happens. So I'll just go ahead and kind of briefly describe what I did somewhat. So this is FB Facebook. It's a stock I like to look at just during the day. No real particular reason. I mean, it's got good volume, and usually the bars are at least 10 cents or more, so I like it. I have really a select few. The main one, Apple, Facebook, Walmart, and I think this one is AT&T. I mainly just trade the spider, mainly the spider, and followed by that probably kind of a tie between Apple and Facebook and then Walmart. And I just like Apple just because usually the moves are big and it's fairly, I like the swings. But anyways, let me just kind of share briefly one mistake that I made. And I really wasn't thinking clearly behind it. And, that happens. And what I did was I think I bought somewhere in here, and I scaled in and scaled in and scaled in, and took to be honest, I scaled in quite a few times, and I got it on it. Let me rethink. Okay, I traded really, really small on this trade, and I was prepared to scale in, and that's kind of one thing I've been doing is trading very small, and so that no loss is very damaging. So anyways, I believe I bought and bought more and bought more. And I bought more somewhere down here. And I think I doubled my position down here somewhere. I really don't remember the exact amount, but I bought 20 cents lower, another 20 cents, and I think another 20 cents. And so I'll use and then I doubled whatever my position was down here. So in other words, hypothetically speaking, if you bought 100 shares, hypothetical situation here, you buy 100, you buy 120 more, you buy 100 shares 20 more, and that would be, you'd be up 300 shares, so then you buy another 300 down here, which doubles it. But anyways, I think I ended up getting out for a small loss somewhere at the end of the day. I really don't remember. I think it was around here. But anyways, the reason I'm sharing that is just it was just really poor management, and I wasn't really thinking about it, and I really should have just taken the loss. And here's the biggest issue. When you're scaling in, you buy low, you buy 10 cents lower, 20 cents lower, you scalp out. You buy this low, 10 cents lower, 20 cents lower, scalp out. And number one is this breakout, you're going to get more down probably. Second off, let's look at the first 15-minute bar. Look at this bar. This closed below the past, I don't know how many lows. So you have all these bulls over here that are trapped. Second off, follow through. And then we get 3 bars down. At some point, it's a breakout. I can look at a 30-minute chart, strong bear breakout, and follow through. And I really just should have, sorry, just one quick second, 18.4. I really should have just taken the loss when I knew I should have. And it would have been, 20 cents. So it's just kind of a reminder with that. And, the reality is that you can buy here and keep buying lower. Price will probably come back up here or back to your first entry. But the issue is time. It may take a day. This is a 60-minute chart, so it may certainly take a while. Here we broke below the low, so we may get a second leg down. So with that said, be aware of how easy it is for traders to make money. So, bulls buy this low, buy more lower, they got trapped. Bulls buy this low, buy more lower, they made money. They buy this low, they buy 10 cents lower. They were unable to, they buy this low. They'd have to buy, so they could not buy this low or this low in 10 cents. They had to buy down here, but you can see price never came back to their first entry. So bulls buy this low, get out, break even. But then look what happens over here. The pullbacks start to become very, very small. 87 to 13 ticks. Usually in general, let me compare it to, well, here's something that, this is last night of gold. Look to the left. We got a bear breakout, but it looks weak. We finally closed below all these bars, but look at the sell-off. Pullback was deep. And then look when we fell below this low. We went below this low, clearly found buyers, went below this low, clearly found buyers, went below this low, clearly found buyers. So it's clear bulls are making money. With Facebook, that wasn't the case. So when the channel gets tight, the first level usually fail. So you're better off selling the bull bars. So that's really it for that mistake. The reason why, the big reason why, this is the problem with these kind of moves. Yes, if you buy and keep buying on the way down, and especially if you double your position on the way down, you can almost always break even by the end of the day. As long as you don't, because this never clearly, it looks like a leg in a trading range. When you see this sell-off, it is strong, but, we break below this low, and then we went sideways for a long time, so we'll probably get back into this area, or back into this low over here. So never went always in short, but it did, I want to say, it did go always in short, but it was never very clear. It did never look like a strong trend or a strong breakout. But these kind of things can go a long way, so the reason why I say I should have gotten out is if I would, getting out early allows you to sell on the way down and then look to buy. And then you can treat this whole thing as a trading range. Alright, let's look at let's take a look at the spider. Spider, a little bit different, 3 bars down, but bad follow through, probably buyers below. So you could literally just buy anywhere and scalp, or sell up here, scale in higher, scalp. But look right here. Very, very tight channel down. The pullbacks were very small. Then we broke below this low. And found buyers below. So, typical trading range day. When you look at this, you're not seeing, when you look to the left, you see trading range. If I, oh, wait a minute. There we go. It's on a 4-minute chart. Looks a little different. Okay. Yeah, so, bulls were buying, scalping, bears were selling up here, scalping out. Bulls, they'll buy, you could buy anywhere, buy here, buy lower, buy lower. But if you look at it, it never really looked strong. Here's a 15-minute chart. Now, we never got 2 consecutive strong bars closing on their lows, as opposed to Facebook. We got that and that. So it's kind of one of these situations. There's going to be a measured move down. You look at a 5-minute chart, maybe of that, or the easier one is measured move based upon this body of the first bar, or you can probably use the second bar, which you can see traders did, or the third, which traders did. And then maybe you'd be surprised how often this kind of trade works, where sell the close, put your stop up here, and then 3 more bars, and then we got a bull breakout. So you take the bodies and go for a measured move of 1 times the open to close, projecting down, and it even went 2 times. So, I don't have a lot to say. If anyone has any questions, feel free to comment. Let me think real quick. Get rid of Solar City, considering Tesla merged with Solar City merged with Tesla. Not really a lot to say. Big day in Walmart. This is a good example here. It always looks like it's going to reverse. That's the problem. You see this and you go, oh my gosh, well, it's climactic exhaustion. Well, it might be climactic, but look at this chart. Let's go to a 30 minutes. See, look at this. 3 bear bars, 4 bear bars. Are you really? Let me see something. Do you really want to buy after 4 strong bear bars? No. So more, just you just sell somewhere. First reversal up should fail. Keep going down, and then look. Well, then you're thinking, gee, I can't buy. I can't sell this. Stops all the way up here. I'm gonna, but you cannot get long. Do not buy because this is too strong. And we kind of just did that. So, that's really it. Think of some final thoughts. Sell off. The odds were trading range day. Bulls will buy here. And so, okay, trading range day, bulls will buy above and they'll buy more below this bar or lower. You can see that's kind of what happened. You buy above, buy more here, buy more even here. Bulls get out at the original entry. Tried to test the open of the day, which is this green line, but came a few ticks shy. Bull breakout followed through, but it's also, wedge, parabolic, 1, 2, 3. Possible second leg trap in a trading range day. That's not going to really work. So when you start to see, bars going sideways to down, there's always the risk of this happening. You're high in the range. Bears will sell, but their stops up here, and they'll scale in and probably make money. All right, that's all the time I have. Comment below if you have any questions, and thanks.